Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome to Phil's Tax Hacks and Other Retirement Facts. Phil Putney and myself, and we're going to talk about some important financial debates. We're going to kind of take a page out of Letterman's old playbook where he would do the top 10. He used to do those top 10 lists. So we're going to do the top 10 things you need to pick a side on in important financial debates, and we'll see if Phil concurs. Hey, did you ever watch Letterman? Did you used to like the top 10?
Oh, yeah.
He had some good top 10, right?
Yeah, he did. It was hilarious.
Yeah. So what I thought we'd do is we're going to break this into 2 episodes. We'll do first 5. We'll do the second 5 next week, and we'll just kind of go through. So we're just going to look at some of this stuff, important financial debates from bonds to life insurance to just a lot of the credit card debt, like a lot of the big things that pop up in our mind.
Sure.
As we're getting worried about this stuff, as we're getting closer to whatever our retirement date might be, or even if we are retired, this still could be applicable as well. So let's just jump right in and start tackling some.
All right.
Go with the biggie, the house.
The house.
Yes. To pay off or not to pay off? That is the question.
Yeah, that has been the debate for sure up until recently when mortgage rates all of a sudden took off again. So yeah, and it's a discussion I have with clients all the time. There's 2 sides of that coin.
Sure.
I always joke and I call it the head rule and the tummy rule.
Right.
The head rule, that's the math behind it. And, typically running the math on it, especially when interest rates were 3%, or lower. I mean, it just didn't make sense. Why would you ever pay off that house? If you can get the payment within a reasonable budget amount, so it fits within the budget.
Right.
Why would you want to pay it off? Take some capital you have to throw against that, especially if it's in an IRA.
Mm-hmm. Yeah.
So there's all sorts of pieces with that. But I mean, it's the way I've always looked at a house is, it's not really an investment. I think a lot of people look at their house as an investment, but to me, at least, the house it's a liability. I mean, it's something that costs you money every year. Even if you didn't have a mortgage, you got property.
And there's always stuff to do.
You've got
landscaping,
maintenance, landscaping. So I mean, there's always something you're putting into it.
Yeah.
So it's almost like you're renting it anyways and maintaining it. So I mean, it's just part of ownership of the house, and it doesn't change your gain in that house value.
I was going to ask you, and then a lot of times we look at it as a taxable situation, like it's a tax thing, but that's been taken away under the current tax brackets. That could come back. Yeah, maybe.
Absolutely. Yeah. I mean, it used to be an advantage to having mortgage interest as it was deductible. So, effectively, if you were at a 5% interest rate and you're in the 20% bracket, well, that saves you a percentage point. So it really only costs you 4 net, so today with the higher standard deductions,
that argument kind of got taken off. Yeah. It kind of added to why keep the mortgage for many people in that debate conversation, because now there's not even the tax advantage. So to your point about the tummy rule, if it makes you feel better and there's no tax advantage, why not just, lop it off?
Well, and then that's the other side of the coin is that, if the math all makes sense and you should keep it, it just fits and does a better job financially.
Yeah.
But at the end of the day, it's going to keep you up at night because you want to have it paid off. I mean, then let's figure out how to pay it off.
Well, Phil, many will argue. Many will argue, well, hey, if it's $1,500 a month, let's just say, and even if it's close on the math, by getting rid of it, I mean, I'm saving $1,500 a month that I could then use towards, putting back into the retirement accounts or whatever.
Sure. Yeah, you can, but if you do that though, okay, where are you going to get the funds to pay off?
Yeah, I mean,
$200,000, right?
Yeah, only if you have it, right? Yeah.
Right, you have $200,000 mortgage to pay off. Well, yeah, if I pay it off, I'm going to save $15 a month. That's great. But where's the 200 coming from?
Right. It's not a lot of times it's the IRA or whatever.
No, if I'm going to pull it from the IRA, that makes absolutely no sense because now it's 200,000 taxable income.
Yeah.
So to net 200 to pay off that mortgage, you're going to end up taking probably 3 by the time you pay federal and in state and,
Right. But what if it's 50 though, Phil, right? I could hear people thinking, well, what if it's only 50 or 70 or, something like that? We're close,
Yeah. I mean, if you get, that's where it might make more sense. I mean, if you have a, $50,000 mortgage and, you're on the last 18 months, 2 years of it, it's not worth refinancing at that point. It's going to cost you more to do that.
Just the stress or the paper.
Yeah. So just, go ahead and probably pay it off at that stage, especially if you got money in the bank. So, I mean, if you've got money in the bank you got a $50,000 mortgage and it's giving you anxiety, just pay it off.
Right.
You're not getting the same interest at the bank that you're paying on that mortgage for sure. That penny earned is a penny saved type of thing.
Yeah, that's for sure.
Penny saved is penny earned. So.
And that's where the strategy's coming into play, right? Because
right.
Yeah, if it's still 200 grand, there's probably not too much in the strategy or the math that's going to make that scenario viable unless you've got a lot of wealth built up. Right. But if it's in that kind of workable window, that's where you can do that logic with the math and then factor in that tummy side. And then, okay, let's make the best call.
Right. Yes. I mean, if it's a $200,000 mortgage, you're at a 1,500 monthly payment. Let's run some numbers and see what you could refinance it at. To me, I would say take a 30-year mortgage, especially if it's going to be a house you're going to be in forever.
Right.
This is your final house. This is where you're going to live out your retirement. Get that payment as low as you can, as long as it's a reasonable interest rate. Now it's a different argument today. It's becoming not quite as reasonable, with the 5.5% interest rates.
Yeah.
Now you got to look at it a little bit more. I mean, when it was at a 3%, it was, pretty easy.
Yeah.
To say, let's keep the mortgage.
I think I'm at like 3.2 and they were trying so hard to get me to redo it whenever, just a few months back when the rates were still really low, and it was like 2.75. And I kept finding myself going, is a 0.5% really, is it worth it?
Is it worth it? Yeah.
And it's like, well, 0.5% over time, but my strategy is set up for me to, it's going to be paid off early, at the rate that I'm going. So it's like, so it definitely.
Are you going to pick up I mean, if you're paying it off, then that's a whole nother scenario to look at in the refinancing. I mean, if it's, running the math out, it doesn't make sense to pay it off. Then let's try to get that payment as low as we can.
As low as we can.
Cheapest interest rate, and just treat it like rent, basically. At that stage. I mean, it's just another cost to owning a house. The value of the house, the equity, it's going to go up and down no matter what the mortgage is. So that, that argument, you're going to still get if the house goes up in value, you're going to realize that, just like if the house goes down in value, you're going to experience that too. So having a mortgage doesn't change that. So,
well, so the topic, or the kind of the back end of this, is, do you concur? And I don't know why we as producers, we decided to put this together, because financial advisors typically go, it depends.
It depends. It's our favorite answer. It depends.
That's right. So should you pay off the house as soon as possible? It depends.
It depends in the scenario. Yeah.
We could say that for all of these, which is why we're going to discuss some of the pros and cons like we just did with the house. So that's the first one. Hopefully that helps. But really, ultimately you got to factor that in. And then definitely, the tummy rule can have a lot more weight sometimes than the math rule. So it's just
absolutely
it's a matter of working through it. All right. Number 2, individual bonds are better than bond funds.
First, before you say, is it better? I mean, there's no, is it better?
Is it better?
A bond fund is made up of individual bonds. So it's, the advantage to the bond fund is you get, with a smaller investment, broader exposure, so you can have a much smaller investment, have a much broader exposure to many bonds.
Right.
The downside you're going to have in a bond fund, though, is that because with a bond fund, mutual funds just in general, there's always this inflow and outflow of money every single day. That manager is having to buy and sell bonds. And that's where, especially in markets like we have today, it's detrimental because as interest rates rise, bonds, naturally, the value falls.
Right.
It's just this teeter-totter. And we've kind of talked about that before. So if that manager in a mutual fund is having to now sell some bonds because this other investor wanted out, so they've got to redeem their shares and give them cash, so they're having to sell bonds. But you, the investor that bought the mutual fund, was buying it for a long hold. Well, now you effectively, underneath this pool of investments, got forced to sell bonds at a loss.
Yep.
So, and that's where an individual bond is more advantageous, because as long as you hold it to maturity, it doesn't matter what rates do. You're going to get your principal back and get paid whatever the rate the bond is paying. So you take some of that volatility of a market out. Now, if you're looking at the value day after day, it's going to change value, but that doesn't mean you lost it. If it's a 10-year bond, as long as you hold it to maturity, in that 10th year, it gets redeemed, it matures. As long as that company, I mean, that's the other caveat, right? As long as the company is still financially capable to pay it, you're going to get your principal back, and now you can reinvest back in.
so many of our normal, I don't know, rules of thumb seem to have been really distorted by the current.
Well, the last 2 to 3 years, bonds, yeah, I mean, they kind of hit their bottom and they bounced along the bottom, right? So they tried raising interest rates and then it fell again. It tries,
Gotcha.
to get a good picture of how interest rates affect bonds, you have to look back prior to that, in the decade or two before that, where interest rates were high and they kept falling.
Gotcha. Okay.
So last time we went through a major market correction, 2008, one of the saviors to that market was bonds, because rates were pretty high. And as they started to fall naturally, and the Fed was reducing interest rates, trying to, help the economy and spur on investment.
Right.
Well, that favors bonds, because now your bond that was paying 5%, now the new market rate's only 4%. Well, your bond's worth more than the face value, because somebody can only get 4 versus your 5. Once we hit the bottom and kind of bounced along, now we're starting to tick back up the other direction. It works just the opposite, where you bought a bond down here and it's paying 2%, and the new bond rate's 3%. Well, no one's going to give you face value for 2%. I'm going to go get a new one. It's paying 3%. So if you want to redeem it, well, you're going to get less than face. That's that discount you experience on the bond.
So let's go to number 3 here on picking these sides on our top 10. Again, we're going to do the top 5 for this episode. Sure. Nobody needs life insurance once they've retired, Phil.
I mean, that's kind of the general thought, it's like, hey, kids are, through college now and the mortgage is maybe paid off. So those are the 2 biggies that typically you think of, I need life insurance. I'm retired, right? So I don't need to replace my income anymore. So why would I need life insurance?
But do you? Because it could, right? It could be a useful tool for that.
And I mean, for us, when we're doing planning, I mean, we run the scenario first to assume both husband and wife are going to live to full life expectancies. Let's run the old adage, plan for the best, but prepare for the worst, right? So we're planning for the best. If this happens, everything works great. How do we maximize their income, minimize taxes, make it all work really good there? Then we're going to go back and stress test that plan and say, okay, that's great. But what happens if, Mr. Client, you pass away today? What does that look like for your wife, or vice versa? Because when either spouse passes, there's several things that happen. There's always a loss of income. At a minimum, there's the lowest of the Social Security benefits gets taken away. So there's always going to be this loss of income from Social Security at a minimum. Second, there could be a pension, right? If they did have a pension involved, what election did that spouse make? If it's 100% survivor, well, then it's not a concern for that surviving spouse. But what if they did a 65% survivor option, which is kind of the standard, at least in our neck of the woods.
Okay.
Or what if they looked at the numbers and said, you know what, I'm going to be the one that lives the longest. I'm not going to take any survivor option. I'm getting the biggest pension, the single life.
Yeah. Yeah.
And then all of a sudden
life happens.
Next year, life happens and they get in an accident and they're gone. Now they have no income. And then the other side of that coin is taxes, because now that surviving spouse becomes single versus married filing joint. Mm-hmm. So all the tax brackets get compressed. So I guess a long answer to say, do you need it? You got to run the math. I don't know. Chances are you might not. Right. There's less reasons for it, but it's not the rule of thumb. Oh, I'm retired, I don't need it.
Well, maybe it's more about insurance or insurance products of some different nature, because, isn't that basically the concept behind an annuity? And I'm sure we'll get to that. But you think about a pension, that's really all an annuity is. And they're typically offered from insurance companies. It's a self-funded pension, right?
It is. Life insurance is typically it's leverage. Life insurance is all about leverage, because you're putting in, and again, depending on the type of product you buy, you're putting in a smaller premium to get a big death benefit and that's kind of term. If you're needing life insurance in those later years, sometimes term isn't going to work as well, because insurance companies know the statistics, right? The closer you get to that age, the probability of you passing away is higher, so that their premiums are going to be reflective of it.
Yeah, you got the actuaries. Yeah.
Right. So then you need to look at different types of products, and maybe a cash value policy makes more sense, where it's accumulating cash inside to help supplement the cost of that insurance. And there's all sorts of cash values, whole life, variable universal, index universal, just straight universal. I mean, there's all sorts of different types of products to consider.
Yeah.
But a lot of times life insurance is more about leverage.
Yeah. And
I'm putting in X amount and I get multiples of that as a death benefit.
Right. And so the old school strategy of just using it for the things we typically think of, it's easy to draw that line and say, no, I don't really need it because once I get to retirement. But it could be a way to do some other things in retirement, even some income supplement, or even.
Well, I was going to say, even way beyond that, I mean, that we just talked about the need, quote unquote, for life insurance. If there's a need, I mean, if there's other strategies that we use a lot with life insurance, I mean, you mentioned income.
That's a good point.
So structured the right way, you can generate tax-free type of income coming out of a life insurance policy. So I mean, it can be a complement to like a Roth type of concept where it's a tax-free or tax-advantaged vehicle. Mm-hmm. Another huge advantage to life insurance today is using it for a chronic illness rider or even a long-term care, depending on the type of policy.
Right.
Where we can now, as the owner of the policy, get access to death benefit to pay long-term care or chronic illness type of needs.
Mm-hmm. Yeah.
So it could be a solution, and it's called asset-based long-term care, but it could be a solution to covering long-term care. And if you use that, it takes away one of the biggest concerns to how do I provide, cover long-term care of what if I pay for it all these years and never need it?
Yeah.
Well, if you do that through a asset-based care, which is at its core life insurance, well, then there's a death benefit. So somebody is going to get a death benefit.
Yeah. And it's got the legacy components as well.
Right. So there's all sorts of, so I guess with any of these, you can't just, look at that rule of thumb out there. Well, they say I'm retired. I don't need life insurance.
I don't need it. Yeah.
Well, you might not need it, but does it fit? It's a tool.
I think
understand how it works and does it fit? If it does, it's an option. And if it's something you're not comfortable with, because it is complex, it takes time to work. You have to understand what you're doing. It's got to be managed. I mean, that's the other big piece of life insurance. It's too many of them get sold as an idea, and then you never see that advisor again. And they're not going to work then because you got to manage and maintain them. Do you want a ballpark type of retirement plan? I think it's going to work. Or do you want to have a custom plan, right?
I want to go to some ballparks in retirement, but
that's right. You want to know, okay, this is the strategy. Hey, if one of us dies, how's that other spouse? Are they going to be okay?
Yeah.
How does all this work? Well, you need to have a custom strategy to run through that math and see what does it look like for you.
So that you can go to the ballpark. And have a ballpark. So
that's right.
Or two.
Or two.
All right. So let's do number 4 here, Phil. Actually, I'm gonna switch 4 and 5 because I think it'll make more sense since we're kind of talking and we touched on annuities in the insurance conversation. So annuities are a ripoff, right? That's that. There's that situational. What is that? That bias where
the bias, right?
Where we can be heard. If you hear something enough, you tend to believe it, which is why the media does what they do. If they push any narrative enough, well, then people tend to fall for it or say that, that must be the case without really kind of doing any of their own research. And so enough conversation has gone around that annuities are bad that we a lot of times will just write them off. But as I just mentioned a minute ago, they're basically just a self-funded pension. I mean, they're basically just something where you're taking your money and you're creating something where you can get paychecks, all through your life when you retire. Are they bad? Sure, they can be, but are they good? Right. Sure, they can be.
I mean, that's like saying cars are bad. Well, no, I mean,
because one had an accident.
Bad. Yeah, I mean, there's some bad cars out there for sure. I mean, been, especially history. You look back, certain cars and models and whatever.
I mean, you don't want to
use and whatever, but it's exactly. I mean, but it's we can't say cars are bad. Well, no,
because the Yugo existed, all cars are bad.
That's right. I mean, it's a tool, right? And annuities, I talk about this all the time with clients. It's just like life insurance. It's a tool, and I don't have any skin in the game either way. I don't really care. Here, let me show you what the options are, how it works. I think it might fit because of this, but it doesn't mean it's the only option. And that's the other side of, if that's the only thing you're being presented, well, you might want to question it because that isn't the only option. There are other options.
If the car salesman's just offering you a Pinto or a Yugo, well, then maybe.
Right. That's right. You better start wondering why. Right? Or maybe that's in your budget, but that's a whole other discussion. Sure. But yes, I mean, annuities, I think out of any investment vehicle are the one that gets demonized all the time. Oh, they're terrible.
Yeah.
Oh,
Yeah.
high fees. There's all
it's
these
really
different
variable
things.
annuities, right, Phil? That's the one that
Yes.
really that's the apple with the worms in it, so to speak, that people kind of tend to, they're all bad.
And they do have high fees. There's risk involved inside the annuity because of the investment. With any of it, you have to understand the different types, right? Because there's many types of annuities. I mean, you mentioned the guaranteed income. Well, that could be an immediate annuity where you're giving up exit principal to get this monthly income.
Yeah. Okay.
But you've given up the principal, right? So, I mean, that's one of the pros and cons. But typically, if you want guaranteed income, that probably is going to give you the highest guaranteed lifetime income.
Yeah. Well,
but if you want some flexibility, there's other options. So it's one of those things. Don't say the whole pool is bad. Know what they are, how they work.
Yeah.
What are you trying to accomplish? Right. Is what it comes down to.
We love our analogies or metaphors here. I was just, when you were talking about that, in my mind, a crescent wrench popped up.
Right.
To me, the worst of all wrenches. Right.
Yes.
But in a pinch, right?
It works. Right. You don't have to have a whole,
It's like a variable annuity, right? You can roll that dial and make that crescent wrench kind of fit, but it slips. It can strip the head. You can
turn that thing over and use it as a hammer too.
It's got a big head
on it.
Right. But so it's like this weird, but it's really not a great wrench, right? There's better wrenches. So the same kind of thing with annuities. There's better annuities sometimes for you depending on the situation, I guess.
Right.
So
it really comes down to understanding what are you trying to accomplish. Personally, to me, where I think annuities fit really well are one of two things. Number one, if you want guaranteed income, you mentioned a pension.
Yeah.
So if you're looking at here's my income need and the only guarantee I have is Social Security and I'm concerned with that, I want to add some more. You don't have a pension. Well, we can give you guaranteed income. The only other place to get that is an annuity. I mean, that's it. Okay. So if you want that, that's how we get it.
That's how you get it.
The other side is if you want some downside principal protection, but want some upside market participation, never keeping up with the market,
like a fixed index.
Yeah, but you're protected from a downside in a market. There are some options there. Yeah. I mean, with annuities, though, the thing you're always going to give up is liquidity, 100% liquidity.
Yeah.
It's a longer term investment. Doesn't mean you can't get access to the money. It just, if you get too much, you take too much out early, there's going to be a surrender charge. It's like anything. There's pros and cons and tools. You have to, or options. Understand what they are. How do they fit? And decide, does it work?
They have all these riders and they have all these little different things you can put on. They're like a little Swiss Army knife, Right. Yeah. You can tack on riders and generate different things if you want, Yeah. So it kind of depends on what you want to do. And I get it. It gets confusing. So then if you hear this narrative, well, they're all bad, and you say, well, they're high fees and they're hard to get out of, there's no liquidity, so I'm out,
right,
or whatever the case might be. But there's all these little variables. So again, picking sides on important financial debates, it's not really, a lot of times it's just not black and white, right? It's just not, there's a lot of gray in there because it's figuring out what's the right tool for the job.
Right. I mean, I would say, just as a kind of general rule, if you ever hear somebody say, oh, this is terrible, never invest in this, you have to wonder why. What's their reason? I mean, there's a famous investor out there that their whole stick is I hate annuities, right? I mean, you probably know who that is, and there's reasons they do. Yeah, that's right. But that's because that's a marketing stick for them. They generate a lot of revenue because of that. They get people on that to say, oh yeah, well, I hate annuities too. I think you're a good fit for me. I've been told they're bad,
That's a good point.
But if you look at that investor's portfolio, or that RA's portfolio, they've got a lot of insurance companies in there.
Yeah. Yeah. My brother absolutely detests Fords, hates them with a passion because he had a Pinto one time when he was 17. Right. And it's like, okay.
Tainted him for life. So
tainted him for life, but Ford makes a lot of nice products too. So, one little, bad experience, and
it's funny you mentioned that too, because I've heard that often too, is, somebody will come in and their parents have passed away and, they had these annuities. I hate those things, or, whatever. And they're making a judgment on annuities, the broad concept of annuities based on that one little experience. It's like, well, hold on.
Yeah.
You're on the receiving end of that. Yeah, you didn't like the outcome, but why did they have it? It wasn't for you. They bought it. It was for them. It fit their scenario great.
That's true.
Well, how does it work for you? You got to, look at both sides of that coin. Don't make a judgment based on your experience way back when or whatever, what you've heard.
That's a great point.
No pros and cons.
All right, well, let's do our fifth one here, Phil, and then we'll wrap it up here. We've gone a little long, I think, but that's okay. Number 5 here on our top 10 countdown. We'll do the next 5 next week. It's better to have a fee-based advisor instead of a commission-based broker.
Again, it really comes down, I guess, to what you're trying to do, right?
Putting him on the spot here, folks.
Well, no. So if you're wanting just I want to buy this stock or buy that stock. Well, that's not a fee-based advisor, right?
You don't need that. Yeah.
Go to your commission, go to your broker that's going to charge you a commission to buy and sell. I mean, that's where that person fits.
That's what they do. Yeah.
Right. But that is what they do. But I think where people get confused here is both of these individuals are financial advisors, right?
Right.
But you've got to understand focus and what they do and how they get judged or how they judge things. I mean, the brokers, so to speak, I mean, they're only looking at suitability. What's your income, what's your assets, what's your risk tolerance? Right. Here's the world of investments I could offer you. And they can pick whichever one pays them the biggest commission. Nothing wrong with that. Not to say they do that, but that's just the world they live in.
What they do, right. Like you said, because they're labeled the same, right. The financial advisor, and because we've seen these emails about 1 million times, well, I never hear from my guy or gal. And when I do, they're just trying to sell me something. Well, it's because you don't have an advisor. You have a broker. And that's how they get paid.
Right. So the next greatest thing coming from their brokerage house is XYZ stock that, hey, let's sell this, and boom, that's where you're getting that call on the phone. Hey, I think this company is a great option, but and whatever. So
and it doesn't make them bad. It makes you, it's kind of on you because you don't realize what their function and their role is, and you're expecting more out of them than the relationship calls for.
Right. Versus like a fee-based advisor. Now it should be not as much about the investments. It starts with the plan. Right. What is your plan? The strategy you've established, looking at everything, your taxes, your income, assets, your need. How does this all fit together? Long-term care, all of this. Now that we have that in place, now let's start to look at the different investment options and how do we put those pieces in place to make that plan work? So it's a more longer term type of relationship
and a bit more lawyer.
The other's transactional. So
it's a bit more lawyery to me. Like you kind of have the person on retainer, so to speak.
Correct. Yeah. Because it's this longer term type of relationship. It's not just here's a portfolio, we're buying and selling, and has nothing to do with
unlike lawyers though, you don't have the billable hours every time.
Well, that's true. That's true.
Where a lawyer gets you for everything. And the same thing with, we joke a lot of times that you wear the counselor's hat, and you can certainly charge more that way, but you don't, right? So it's kind of part of the customer experience, I guess, the customer service of the whole thing.
Right.
Yeah.
Okay. Yeah. So it just, I guess, comes down to understanding the differences and understanding what you're getting. The fee-based advisor is a different relationship. That's where you hear this fiduciary standard come into play. Right. So, I mean, they're still following suitability, but now they got to take it a step further. And as they're looking at those investment options, make sure it's in your best interest. Mm-hmm. So out of those 3 that might fit, which one is best for you, not necessarily for them. Mm-hmm. So it's, in my mind, for most people, I think it's a more suitable option. But if you're that savvy investor and you just want to, be in these individual stocks and buy and sell all the time, and, you want this brokerage firm and their, experience and whatever, and they're going to buy and sell and, give you the latest and greatest, then that's your avenue.
Yeah,
totally different thing. Don't expect them to do all this planning and strategizing, because that's not what they do typically.
Right.
They're more about the investments and buying and selling.
If you're looking for a long-term relationship type of situation for the preservation of your wealth, AKA retirement and retirement distribution, then you go with a different style advisor, because everybody and their brother can slap that advisor label on now. So
that'd be like going to your cardiologist and say, my knee is hurting. Can you take a look at that? And he's going to say, what are you talking about? That's not what I do.
It's hilarious. When I do see my cardiologist, he'll ask me how things are going. And one day I mentioned something, it's like, sometimes I'll mention something else, just kind of in talking and saying, I wonder if the stress of this is causing me stress, which
there could be a connection.
I'm trying to get to the point of the connection. And some days he's listening and other days he's like, I don't work on those. Yeah, I know, dude, but I'm trying to get to the point, right?
Is there a connection?
I'm trying to make the connection. Work with me here. So, all right. Well, that's our first 5 there on the important financial debates. We'll be back next week with the other 5 of our top 10 kind of countdown, if you will. So, Phil, thanks for hanging out as always, my friend. I appreciate you. And folks, don't forget to subscribe to the podcast, Apple, Google, Spotify, YouTube, whatever platform. You'll see all the stuff on the screen. You can also just stop by the website, philstaxhacks.com. That's philstaxhacks.com. And of course, if you need some immediate help, jump on and call Phil at 248-888-7530. That's 248-888-7530. And we'll see you next time here on Phil's Tax Hacks and Other Retirement Facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.